delay too, by the way. Hey, everybody. Appreciate you all being here. I'm trying to get it on my end to make sure that we are live and in person. And I'm seeing I have to hit retry on my YouTube. If you see me looking over here, I'm just looking at my my other platform here to make sure that the stream is flowing. And all right, good. So it looks like we are. Where is this thing? Hold on just a second. All right. All right, so Mushki, you are there. Hey, okay, good. So looks, hey, Harry. All right, good. Let's you all see and hear us. Is that correct? Can you see? And I can't. Can you see both Tom and me on here? What are y'all seeing out there? Because for some reason on my YouTube thing, it's not showing up. Hans, que paso? Bear me just a second, Tom. We're gonna make sure. Okay, good. And Harry, you hear us as well. And you see both Tom. Okay, cool, good. All right, looks like sign me up. I think I know what happened. Sign me up. All right, so welcome aboard, everybody. Appreciate y'all being here. I tell you, and you all know that I am not an enemy of home equity conversion mortgages, otherwise known right on Mac as reverse mortgages by any stretch of the imagination. Not to use the arrow in your quiver as part of a retirement plan doesn't make sense to me. And that doesn't mean you go get one. It means you look into it to see if it fits you, man. It's nuts. We have more home equity than we have investment accounts. I've never understood the idea that it's a scam. So you've heard me talk about this a million times a Sunday. I got one of the experts in the business on, Tom Dickson from Financial Experts Network. And Tom, I tell you, man, Tom's been talking about this kind of stuff for a long, long time, which you wouldn't know because he looks like he just graduated college. So Tom, welcome aboard, man. Hey, we got Susan. Thank just you. Said she notified 20 of her friends, and she'll check with us later. So speaking of which, Tom, hold on just a second. This will be available later on this very page here. So Susan, tell your friends if they can't make this, they can make it later. And you know, we'll share with you links to Tom's page and all that too, for sure. Because I'm stoked by this. So Tom, welcome aboard. Give us don't say where you're from, because we're gonna see I will not. And give us a gauge, but tell us a little bit about Tom, if you would.
Yeah, absolutely. Well, Josh, thanks for having me, and everyone, thanks for tuning in. Really appreciate the opportunity to visit with you tonight, and I will not disclose where I am domiciled, and you'll have to guess just based on my accent and my slang. So there you go. Now I'll give some hints along the way, but anyway, delighted to be here. I've been in the financial services for a few decades, despite Josh's nice comment there, but done a variety of things over the years. I've been in the mutual fund industry. I helped start, I was sharing with Josh, one of the early online brokerage firms. I've set up investment programs. And then I sort of, I took a left turn in my career. And about 11, 12 years ago, I got enamored with this funny, crazy product called reverse mortgages. And full disclosure, my wife and I are small-time real estate investors. We have been for 33 years. So we're a little partial to the use of home equity. We believe if you do it prudently, it can certainly help you build your wealth. Or conversely, if you've built up your wealth by using home equity, be it in your home, why not at least, and here's the point I'm always going to make, consider it. So I'm not here to advocate that, look, everyone should use a reverse mortgage. That's not my shtick. My shtick is that you need to thoughtfully learn about it and make sure you have the right people in your life educating you. So with that, let me just walk through. And by the way, I'm going to switch to my slide.
You ready for me to, and by the way, all right, there you go, Tom. And by the way, folks, feel free to ask questions. I'm going to let Tom, take the reins with this, but I'll monitor it. If anything comes up that we need to interject, by all means do so. We'll also do Q&A at the end too. So Tom, it's it's on you, man. And I don't think you can see me, but I am sitting here. We'll be paying attention. So just take it away.
Great. Yep. Thank you. All right. So let me, by the way, there's my information. If I can be of any help to any of you after the session, feel free to email me. I do try to respond to every email. So again, if you have questions post session, don't hesitate. I'm here to help. I'm on a personal mission to help anybody as best I can. My website's up there, Financial Experts network.com. Josh is actually familiar with it. It's all about education, not only on this topic, but really all the important financial issues in your life. So feel free to visit that. And most importantly, I hope you give a shout out to our 2 rescue dogs. We're a family of rescues. Our latest, Kira, is a LinkedIn star. I posted that photo about 4 weeks ago on the left. She's just a cutie, and we just got her, and she got over 3,500 views on LinkedIn. And then my sweetheart on the right is Leia. She's a real mix as well, and she's a treat. So anyway, sorry.
Hey, Tom, just real quick, guys, when we first started chatting, I said, Tom, I hope you don't mind my dogs, because Tom, my YouTube channel knows that my 2 dogs can be very active on my channel. And Tom said, nope. In fact, on the very first page, you'll see my 2 dogs. So we are a dog channel here. That's for sure.
They are popular. That's for sure. No question. Yeah. All right. Well, so let me start with a few really, I think, basic but very, very important points here. Number one, and we'll get into a few different terms, and I'll try to keep it very, very straightforward. I want it to be very approachable. I think what's really important is for people to understand, for everyone to understand, that the most popular type of a reverse mortgage, and there generally are 2, and I'll touch on them, but far and away, the most popular type of a reverse mortgage is one that's insured by the U.S. federal government. Now, put your politics aside. I can tell you in this case, it's that backing, that sponsorship by the federal government is absolutely a good thing. And I'll give you examples of that as we advance through this talk. And just to add to this, so of all the reverse mortgages that have been used by over 1 million older Americans since this program was authorized into law by, admittedly, one of my favorites, President Reagan, in 1988, over 1 million people have used this type of reverse mortgage, which is called a home equity conversion mortgage, or HECM. We love acronyms, or HECM. So again, the majority of reverse mortgages that have been used by older Americans, over 1 million, is this home equity conversion mortgage. It comes with lots of oversight. I think, in my experience, again, I've been around mutual funds, insurance products, etc. I think it's the most regulated financial product, and I'll give you some examples as we advance here in the industry. So I wanted to start with that point. I think the backing and the safety that the government involvement brings is really important. Now, at a very, very basic level, what is a reverse mortgage? Well, essentially, it's a loan that allows homeowners to be able to convert or access their home equity by converting that into some form of tax-free payment. So again, it's essentially taking, I don't care for the term necessarily, trapped home equity, but if you think about your balance sheet, when you list your assets and your liabilities, when you list that home equity asset, it's really not doing anything for you. And what a reverse mortgage does is allow you to possibly make that liquid, if you will, or liquefy it. And generally, home equity conversion mortgages, or HECMs, are available for couples, be it a husband, wife, same-sex couple, whatever it may be, provided at least one of you is 62 or older. The youngest can literally be as young as 18. And I'm not here to comment on that. But that's all it is one of you has to be 62 or older. Now, the 60 reference, there's a second type of reverse mortgage, which is not as common, but it's growing, and that's what's called a proprietary or a jumbo mortgage. I'll touch on that a little later, right? But let's go through a few important facts. So if you, in fact, use a reverse mortgage, number one, you still own your home. So while I'm going through some of these facts, I'm going to crush or dispel some of the myths.
Yes.
The lender does not own the home. This is to point number two. Guess what? This is just like any other loan or mortgage. A lien is filed, a mortgage is filed, but the ownership still stays in your name, period. Just like any other loan, right? Number three, I sort of shuffled this around for tonight because I think this is really important as well. If you have a conventional mortgage, meaning that you're making monthly payments, you're either with Wells Fargo or Loan Depot or Rocket Mortgage or whoever, you could actually still use a reverse mortgage to get rid of or pay off that existing mortgage. Assuming, generally speaking, I'm going to give you a benchmark.
Yeah.
If you're 62 and you have 55% in home equity, you will qualify for enough, and I'll give you some examples here in a few minutes, to actually access enough using a reverse mortgage to pay off that existing mortgage. And why would you do that? You get rid of those monthly payments. So point 4 is with the reverse mortgage, the big feature that everyone's generally familiar with is if you use a reverse mortgage in that example, or others we'll look at as well, you don't have to make a monthly payment. So clearly that's part of where the slang, as I call it, the term reverse mortgage came from. So it's sort of the reverse of a typical mortgage, right? You get money and you don't have to make payments until you move out of the house, either standing or not. That's when, just like any other loan, it becomes due and payable. And again, we'll touch on some examples of that. Now, again, as I thought about tonight, this is a new slide for me. You know, one of the uses, I've been around this product for about 12 years now, and my specialty was really educating financial planners like Josh, and kudos to Josh, because I wish, and I mean this sincerely, I wish every financial planner was as open-minded as Josh, because they would be really, I think, doing a true service to their clients to introduce ideas like this. And I believe that 100%. So why add this slide is one of the ways to think about this. If you've got assets, and God bless you if you do, you've got qualified accounts, retirement accounts. In other words, you maybe have savings in your brokerage accounts. And then guess what? You have I was trying to figure out how to represent this, maybe a third bucket where you have that home equity build up. Well, guess what? Not all those buckets or those pots of money are the same. Some have tax implications when you go to access your assets or your principal. Some will be subject to taxes and some won't. So I give you this slide just to think about it. One of the benefits of thinking about a reverse mortgage or potentially using it, along with the idea of a HELOC as an example, is that any money that you draw out using a reverse mortgage is tax-free. You're not taxed on that. So for any of you listening, and if you have concerns or you find taxes to be irritating, how many of you would raise your hand to that, right? This is, again, another reason to look at this. All right, now let's talk about the who and the what. So again, I mentioned on one of the early slides there, the age requirement. So for the home equity conversion mortgage, I've already mentioned, if it's a couple or if it's just a single, then you'd have to be 60 or 62 or older, to use the home equity conversion mortgage. If you look at the proprietary or that jumbo reverse mortgage, which is growing in popularity, that's available in 26 states. Whereas the home equity conversion mortgage is available in all 50 states. Now, beyond the age, what's the difference? You've got this jumbo proprietary and you've got this HECM program. What are the big differences? The jumbo proprietary was largely designed to help folks that have really high value homes. So if you have homes worth $2-3 million or more, by the way, I hope you have an extra suite because I'd be happy to move in. Just throwing it out there.
With
right?
the dogs.
With 2 dogs, we're coming, right? We're playing, we play a lot. But I have to say, if you have a high value home, that's where the jumbo or proprietary product comes in. That it allows you to access more money. The home equity conversion mortgage is a great program. It's helped many, but it has a lending limit. You can only access so much money. And I'll give you examples. Just hold on. I'll show you some numbers with that. So we talked about age. We talked about jumbo. We talked about HECM. Now, the what is what type of property can you live in? It has to be, number one, your primary residence. Mm-hmm. And the type of property can be a single family home. So think the classic single family home. Condos, with the HECM program, that condo has to be FHA approved. And if it's not, many of the lenders can help your association, if they're willing to go along with it, get that complex approved. And they always should be, by the way, townhomes. And then if you happen to live in I should say 2 to 4 unit apartment building, provided you occupy one of those units, guess what? You can actually get a reverse mortgage on the entire value of that multi-unit building. Now, let's answer the big question here. Geez, are these safe? So we've already told you, guess what? The bank's not going to take your home. You own your home. What do you have to do? You have to continue to pay taxes and insurance, just like you have to do with a HELOC or a regular mortgage, right?
Tom, can I interject real quick? You don't have to go through the 26 states, but just generally speaking, a list of states for proprietary reverse mortgages.
Great question. So think of your high value states, which would be California, right?
Connecticut, I'm presuming. Connecticut, New York.
I don't know about Connecticut, New Jersey, Florida. I'm going to say Arizona, Oregon, Washington. I definitely will provide a list, and it's growing. Josh, the good news is it's growing.
But generally speaking, the higher value real estate states. Okay,
higher value states. Yeah, absolutely. Cool. All right. So one of the big things that I really like about the way this product is governed or supervised, candidly, is the middle icon there. If you actually apply for a reverse mortgage before you can kind of go to the second step, you actually have to do a 1 hour call. It's called counseling. You have to go through a 1 hour, generally 1 hour counseling session with a third party, unbiased, not a loan officer, not related to the lender. They have no vested interest in terms of whether you do this reverse mortgage or not. I think that's a beautiful thing. If you were to vote for me as president in the next cycle, I'm not announcing yet, but anyway, I would put this in place for every financial product out there. I would, absolutely.
Oh, especially a first mortgage, never mind, just a regular mortgage too. You know what I'm saying? Why not, man?
Absolutely. Because we talk about suitability, and you're familiar with all that stuff, Josh. Like, I mean, my God, why wouldn't you do that? And here on top of all that, you can actually invite, as I have there, a family friend. You can invite your financial planner. You can invite whoever you want to listen into it. But largely, the reason this was put in place is they want to make sure folks really generally understand they have their cognitive skills. And they generally understand what they're getting into. You don't have to be expert on the reverse mortgage. They want to make sure you're not being coerced into buying an annuity with the proceeds of a reverse mortgage. We would slap everybody that ever tries to talk to you about that, right? And just again, and have you thought of other options? I mean, it's almost like they're not trying to sell you on not doing it, but they're certainly not pushing you down that way. So of the safeguards in place, that one jumps out at me. The non-recourse, it's to my knowledge, it's the only residential mortgage that has what's called a non-recourse feature. That means that if you use one, and your kids, we always think about our kids, right, until the day we're not here anymore, would have no liability if you in fact use this and you use up all the equity, and in some point you owe more than what the home is worth. Guess what? The only liability, the only collateral is the home itself. You have no liability, nor would your children. So that's a very important point. And by the way, I'll just finish that off. So if you use this and you draw $1,000 a month for 50 years, you live a really long life, and your home is worth $1 at the end of your life, right? Again, you do not take the loss. If you're living and you move away, you don't take the loss. But let's say your home was worth $5 million and you've used up $500,000. If there's a profit, you get the profit. So you have the upside, or your kids, you have the upside, but you're protected on the downside. Now, no prepayment penalty. Some other safeguards I wanted to mention as well, and we'll reaffirm as we go. Now, oftentimes people ask, well, geez, how much can I get? It's not the lottery. I will tell you this. It's based on 3 factors. One is what your home appraises for. And again, there's a formula, and I'll explain this on the next slide. 2, the age of the youngest borrower, and this is an example where it's actually better to be older, because the older you are, the more money you qualify for. And then the interest rate. And one of the things I made notes, if there are notes I want you to take away from this, is one would be make sure if you look at a reverse mortgage quote, and I'm happy to help you do that. I'm happy to look at any quote you get, because I'm going to tell the truth. If you look at anything, I'm going to give you my honest opinion. I'm going to make sure you look at multiple interest rate options. So for all of you, if you ever look at a reverse mortgage, there are, just like a regular mortgage, right, where you can do 3% and pay 1 point, or 2.5% and pay 4 points, or whatever it may be. It's sort of similar with reverse mortgages. So I want you to know that. And low interest rates, like we've experienced for the last, whatever it's been, 9 to 12 months, bumping up a little bit, actually mean that you can access more. So the relationship between how much you can access and interest rates, there's an inverse relationship. So let's put some numbers to it. Hopefully you can see on the left-hand column, the home value for a 62-year-old and the 80-year-old, $400,000 the same. The money that's made available, it's a percentage. It's sort of like the loan to value, like 75%, 80%, 90% when you buy a home. But again, it's lower, and that percentage will be influenced by, again, the age of the youngest client and the interest rate. So look at the 82-year-old. They qualify for 62% of the value of that appraised value, right, versus 51.3 for the 62-year-old. So here, it is better to be older. So again, age has a big influence. There are fees, by the way, and I'm sorry, I meant to add a slide on this. You're going to have initial fees with the reverse mortgage, largely comprised of 3 things. The biggest part of it is what's called an FHA mortgage insurance premium.
Yep.
It's 2% of whatever your appraised value is. Now you might cringe and say, "Oh, why do we have that?" And by the way, you don't have to pay these fees out of pocket. You can just add it to the loan, so to speak, and net it from what's available to you. But guess what? That FHA insurance, just like any other insurance product, it comes with some value. It truly does. In this case, remember I mentioned that non-recourse feature.
Yep.
That example, after 50 years, if you've used a lot of money, God bless you if you have, and it's really helped you live a better life, a better retirement. And if that home is upside down, well, guess who takes the loss? It's that mortgage insurance fund, right? And guess who guarantees that you're going to get that check in the mailbox every month? It's that mortgage insurance fund. So just like any other insurance product, it comes with its benefits. There's a cost, but there's a benefit. Now, here's an example of what I'm highlighting left to right. Remember, I mentioned that I really want you, if you look at this, you have to look at multiple interest rate options. So these 3 columns, they're all 62 years old, same home value. The difference in the second row, right? Look at that, pretty dramatic as to what's available to that same 62-year-old. It goes from 51.3 to 43.1%, right? It's over $30,000, almost $33,000. So that interest rate choice in the bottom row, I'm showing you what the interest rates actually are for these 3 different scenarios. It has a big impact in terms of, number one, how much you could qualify for, and it potentially has an impact on what your initial fees will be as well.
Tom, can you go back real quick? Can you pay a point to buy a lower rate to get more to qualify for more?
No, I wish you could, Josh. Again, another reason to vote for me in a few years, but no.
Gotcha.
Yeah.
Okay.
Yeah.
And
Yeah.
if the 62-year-old is married to an 18-year-old, is it based on the 18-year-old, or is it based on the oldest eligible borrower?
Nope, it would actually be based, if they're both on title, that's a big point. It would be based on the 18-year-old.
Gotcha. Okay, gotcha.
So,
right on. Right. If he's on the deed, is based on, or he, I mean, it could be anybody. I hate to be prejudiced here, but if he is on the deed, who is 18 years old, is based. But if he's not on the deed, it's then they don't own the home, so they're not.
Correct.
It has nothing to do with. Okay, gotcha.
Yeah. Yep. Okay, so here we look at this pot of money, which represents your home equity. And if you are to use a home equity conversion mortgage, or again, one of these jumbo proprietary reverse mortgages, essentially you have options as to how you can access that money. And again, as a reminder, in the bottom, in the center, in the middle there, if you have an existing mortgage, this still potentially could work, assuming that you have enough home equity built up that you qualify for enough that you can pay off that existing mortgage. But let's say, if you have a fairly modest mortgage, or you have no mortgage at all, you can actually set up in the upper left-hand corner a monthly payment for life. You could get a monthly check, again, tax-free cash. Lower left corner, you could actually get a monthly check for a period or a term of your choosing. Upper right-hand corner, you can draw a lump sum. Again, you can draw a bigger pot of money in the first year, and then whatever you qualify for in year 2. And then the lower right-hand corner is where you could set up a credit line. And this remains the of the product. So in that same example, looking at the 62-year-old with the home worth $400,000, they start with, at age 62, a credit line similar to a home equity line of credit, right? Available to them of $191,763. But what's unique is the amount available in that line grows month over month, year over year, and please listen closely, regardless of what happens to the value of the home. In fact, you can see at age 80, it's grown to $321,154. And at age 90, it's grown to $434,024. And again, let's say at age 90, the home is still worth, it hasn't appreciated at all, $400,000. You at that point, let's assume you haven't used the line, you have that $434,24 available to you. You can contact your lender and request that they send you a check for $434,024, even if your home's worth 400 grand at that time, or even if it's worth $1. So this is, again, in all the retirement researchers that have looked and studied this, and I've been involved in some of that work over the years, this is the number one thing that jumps out at them. They just think it's such a great hedge.
Yeah,
Yep, and glad to hear that, John. And I would share practically, I've seen so many people use this, especially where they worry about things like in-home care, long-term care, things happening to the market if the market goes down for a protracted period of time. It's just, again, what's it doing? It's liquefying that asset that you have on your balance sheet to make it available for the if in life, as I call it. So again, I am an advocate for this. If you can make financial sense of it, I'm a big believer in it. This just to continue on with different uses, and this, these are real. Some of these are real life examples. Imagine, I see a lot of folks in their 60s, 70s, and 80s. And by the way, I should have mentioned, I'm not a loan officer. I've been in this for 12 years in the thick of it. I've traveled all over the country. I've been lucky enough to work with folks like Josh all over, and a lot of their clients. But I'm not a loan officer. I do have a firm that I'm tied to that's a sponsor of my educational webinar series that I trust 100%. So just, again, full disclosure. So I share that in part because this came from, one of their absolute reverse mortgage experts. So 68-year-old couple in New Jersey, making a big monthly payment every month, $3,387 plus a month. They had 20 years left of an existing mortgage, over $800,000 going out. Well, guess what? They could actually get rid of those payments, stop that, and by putting a reverse mortgage in place. Now, the thing is, one of the things you always have to look at, and again, I'm always here, I'm happy to help you look at this. You want to look at what your loan balance will be if you use a reverse mortgage at a future point in time for the next move in life, whatever that may be. Might be a right size, it might be long-term care, it might be whatever. But I point that out because that's one of the things I did in this case, is just to look and say, okay, what would you have left to work with again in 10 years? And then also this is a great example where they had enough equity post payoff to put albeit a modest credit line in place relative to what they have as well. So I see a lot of that. In fact, 68% of all the financial planner cases that I saw back in the day when I was in the business 3-4 years ago, 68% was that scenario where I have another one represented here, where the financial planner clients actually had an existing mortgage, used a reverse mortgage to pay that off, get rid of those monthly payments, and they put a credit line in place at the same time. Here's another.
No, go ahead. But it just boggles my mind, Tom, when people are like, I'll just keep eating that $3,300 a month mortgage. And I'm like, why?
Well, too, Josh, when you see that big number, I mean, this is what jumped out when I ran the numbers for this. He's one of my subscribers, Josh. This is a financial advisor. And, I've known for several years. He trusts me, and he had me run numbers. And then again, I connected him to one of my sponsors, Joe Damo with SunWest Mortgage. I'll share that. I go back with Joe for 12 years. I trust him like a brother. And anyway, when I ran the numbers, I said, oh my gosh, $812,993. That's a huge number. So, and then here's another example where a refinance, again, a 77, 79-year-old couple. This is, again, a financial planner out in Oregon, Ben, one of his clients. Again, late 70s, making mortgage payments. That's a lot of anxiety. That's the other sort of non-quantitative issue. So they were thrilled. They when the financial planner first said, hey, let's look at a reverse mortgage, they're like, we thought you liked us. Right. And then he showed them how it works. And this is a snapshot, by the way. Again, if anybody wants some analysis done, I have a Excel calculator that actually my assistant, Missy, full disclosure, is my Excel whiz, is built that we can model any situation that involves like a payoff of an existing mortgage and a potential use of a credit line. And you could set these credit lines up, and then you can design how much you want to draw at different points in time. And again, we can model all that for you. So if that's of interest, again, you can email me or reach out to me, Tom at financialexpertsnetwork.com, 3 blah words in there, financialexpertsnetwork.com. But other thing I just want to go through quickly, again, monthly payment is an option. That guy on the left, not as handsome as Josh, but hey, what can you say? You can see at 62, same home value. He would draw $803 a month. Again, the 80-year-olds would draw $1,403 a month. So this is an option where if you said, hey, I don't think I want to do that credit line, but I'd just like to get a monthly check, sort of like Social Security, right? That's an option. And then let's look at, again, this is one of the things I really would want you to look at. And this is why you have to work with someone that you really can trust and really has, honestly, the competency to look at things like this. So again, this is something out of that spreadsheet where we forecast, in this case, looking out to age 82, if you draw on that, start that monthly payment at age 62, what do you have in terms of net home equity? In other words, at 82, if you say, hey, I'm gonna finally move, right? I'm gonna downsize, right size, what do you have to work with? Well, we project that you have $217,588. Well, guess what? Now at age 82, if you, in the first point, if you net 185,263 net of commission, closing costs, etc., right? And now you go to buy another home worth $400,000. And this was an aha moment, Josh, for Larry Kotlikoff, by the way, because you can actually use a reverse mortgage to buy a home or a condo, right?
Exactly.
So, big deal. And again, so whether you're doing that or you're moving on or you're renting or you're moving in with your kids, whatever it is, I always want to look at what you have to work with. But I want you to know that depending on how much you have to work with, you may be able to buy another home. You may be able to right size, and you may still even have some cash left. And again, with this purchase option, so again, you can use a reverse mortgage, provided you're age eligible, to buy another home. And again, depending on your situation, you may have excess cash. So you could actually use a reverse mortgage twice in your life, is the point I want to make. Now, let me just say a little bit about the jumbo and reverse mortgages.
Yeah.
Yep. And to give you an example, so on the left, this is the home equity conversion mortgage. Now, I've changed the value of the home to $2 million. And I did that intentionally to show you that the amount that you can qualify for, you remember that 51.3% in the second row there, right, is always going to be calculated. It's going to be multiplied by the lesser of your home value, your appraised home value, or that FHA lending limit, which for the HECM program is 822,375. So this is where the jumbos come in. If you look at the far right, their LTV, what's called actually a principal limit calculation, is actually a little less typically than what you would have for a HECM kind of straight up. But in this case, if you see the 541,600 times, you qualify for more money in the available money off that $2 million value because you're not subject to that FHA lending limit. Big point. Number one. And then number two, I wish I could highlight this. In the initial fees column, you don't have that FHA mortgage insurance premium. So your initial fees will actually be far less than what you would have with the HECM program. Now, again, there are pros and cons. There aren't as many payment options with the jumbo or proprietary programs right now. Again, they're evolving, but it certainly can be an option for you to look at. And then the other thing, of course, is the interest rate is certainly higher as well. By the way, I realize my principal limit calculation, that 62% is off, of course. I think we're more in the 27% range, just off the top of my head.
Tom, go back for just a second. Are these non-recourse loans on the proprietary ones too?
Great question. Yes. Yeah, absolutely. Yep.
Now, the interest rate, let's just say you take the line of credit at 62, but you don't take a draw against it. Is your line of credit growing at that interest rate at 6.5?
Well, so Josh, right now on the jumbos, generally speaking, there's only the lump sum payment option. Gotcha. So if you want to draw and you don't have to take, like in this case, if you qualify for 536,873, you don't have to take every dollar. You could take 200 grand, 300 grand, whatever. But you can also use it for, again, if you have a conventional mortgage in place, to pay that off as well. This goes up to, I think, the last I looked, for homes worth at least 4 million, if not 6 million in value. So if you're lucky enough to have that, it certainly is an option to look at.
Cool. Yep.
Yeah. So here's just a summary of some of the benefits. Taxes are no question, avoiding taxes and being, hopefully wise about how you access your savings. This is absolutely using a HECM or a jumbo product can help you reduce your tax bill. I've seen folks use it for delaying Social Security as an example. I've seen it, again, for the in-home care expenses. Certainly the last point, again, I was involved with research from Harold Avensky. I sponsored it in 2011, one of the top financial planners in the country, just looking at using the credit line to access when your portfolio might go down a bit. If we have a down market, it certainly makes a lot of sense. And of course, Wade Pfau, I've helped educate him a bit, had him a lot of my sessions. And again, he's done a lot of work on this as well. Now, here's a summary of the four nevers. Again, I'll just encourage you to look at this, to reference this on your own. I've touched on, I think, a lot of these, if not all these points. Not giving up title. You never have to give up title. That non-recourse feature or protection, you never owe more than the value of the home. You don't have that liability. The only collateral is the home. The taxes and insurance, you always have to pay that. I'm going to restate number 3. Right. And by the way, and again, there's a crossover point. So like those examples where I had that monthly payment of like $802, $803 a month, like literally if you live to the age of 162, you could get 100 years worth of payments, even if the value, it could exceed the value of the homes. And then the last point, monthly payments are never required. And if you do make monthly payments, by the way, it actually, if you have a credit line, it'll build up the value of your credit line dollar for dollar with whatever you're paying. last, as I come to a close, I encourage you to visit my site. Largely, take advantage of all the sessions we do. Josh is kind enough to let me mention this, but also under past webinars, if you look under the financial advisors or investors tab, it should be under both. If you look under past webinars, I've done a few sessions recently on reverse mortgages. I've had top economists like Larry Kotlikoff on. Yep. I've done a lot of sessions over the years. And then I'm just very early on, we're starting a Facebook group. You're welcome to reach out to me on Facebook under Tom Dickson. The group is Retirement Questions with Expert Answers, experts on a lot of different issues. And then, with that, I'll leave you with my email. And then at the bottom, I can send you a link if you're interested in seeing numbers. I'm happy to facilitate or enable the delivery of a quote to you through one of the partners that I trust. So with that, Josh, thank you. Really appreciate the opportunity here, and I'm happy to take any questions.
Right on. So Tom, first of all, I get this question a lot. Who do you like? You have you said Joe with Son or something like that. Is that your go-to guy?
Joe. Yep. Sorry, Joe Damo. I've known him for 12 years. He's probably done more reverse mortgages than anyone in the industry, Josh. Okay. He's been doing it for over 20 years. Real easygoing, not pushy, works with hundreds of financial planners all over the country. He and I are a tag team, and again, that's my go-to.
Okay. Right on. And so let me ask a question on reverse mortgages. The jumbo is a non-recourse. That's huge. I did not know that. So I learned something here. And folks, just let me reiterate what that means, a non-recourse, which means it matters not what the loan is at your death. You or your estate or your kids owe nothing to the mortgagor or the lender, I should say. That's a non-recourse loan. And I agree. I don't know any other loan that's like that, frankly. And the reason they have that is because you pay, 2%, Tom, of appraised value as the mortgage insurance? Is that what it is on the front end?
That's on the home equity conversion mortgage, but on the jumbo or proprietary product, you don't have that insurance premium. Yeah, but yet you have that benefit. Yeah, I know.
Yeah, that's huge. All right, so I want to just real quick, we're going to go through some of these not real quick, but just in the back of my mind. Oh, but Tom, Dave Ramsey says reverse mortgages are scams, and Dave he knows what he's talking about, doesn't he?
Not at all. I wish I'd be happy to have him on, Josh. If you want to invite him on the show and we can have a friendly debate, I'd be happy to talk about it. No, that's I get the whole debt elimination system. Right. I get it, but listen, the prudent use of any asset is always something to consider. Again, I'm not going to advocate that you use up all your home equity and you kind of have your blinders on. No, but have I seen the use of a home equity conversion mortgage? It's literally been used by over 1 million people. Absolutely. So again, you have to look at things like, okay, what's my loan balance going to be 5 years, 10 years from now? And by the way, for many, you'll be totally fine. But yeah, no, just to say a blanket, Jesus, a bad idea, Josh. No, that doesn't make any sense. That's like saying the same with other products. You don't.
That's what I say. It's like firearms. I mean, a firearm never killed anybody. A person killed somebody. A reverse mortgage never put grandma out. I'm just telling you, a reverse mortgage did not put grandma out any more than not paying property taxes put grandma out, because that's what puts her out. It's not the reverse mortgage.
Yeah, you're right.
James Murphy always wondered how they could do a non-recourse loan, not PMI, it's just a mortgage insurance. So you are paying premiums. I mean, you do pay as part you pay insurance premiums, Jay Murphy, to make sure that it's a non-recourse loan. But it's 2% on the front end. 50 basis points every month or something like that.
Yep, okay. You're at my mind, Josh. So, 50 basis points on any loan balance.
On a balance. On any balance.
Right. Right. Yep.
I'm telling you, if you're 62 and not at least thinking of a line of credit, I don't. It's nuts to me. All right. Susan asks, are there some scams that people should be aware of out there? Are you familiar with?
I would just be careful. I think, you have to, I hate to use a broad brush, but you have to be careful with the lender, or if you're talking with a broker. Brokers, the way they charge and the way they get compensated, it's sort of, it's not necessarily aligned with your interest. So I think you have to be careful with, one, the person or the lender that you're engaged with. And then two, again, what you're looking at, the factors like those loan balances, things that I project, that's why I created that calculator, right? Because I want to be able to look at everything. I want to be able to stress test it. So you really, I think the quality of the person, it's really important. And then the last thing at least comes to mind, there's certainly a few things to think about. If anybody is trying to talk you into taking a reverse mortgage, getting that in place and then buying another financial product, run for the hills.
Yep,
run for 100%. The hills.
Could not agree more. Arnold, you talked about this, Tom, but he wanted the idea about using for purchase home equity conversion mortgage, which I think is fantastic. Would you mind just, again, this always still, I think it confuses me still this day. So you're sold your house, we'll just say $500,000, and you got $250,000 equity you're walking away with. You're going to go buy another house for $400,000. So just you can use whatever numbers you want to make. But just kind of go over how someone who's going to downsize, how they're going to use a home equity reverse mortgage for purchase. Can you go over that just a tad?
Sure. Yeah, I'll use our personal example. My wife and I just downsized last fall. And I'm not old enough yet. I'm getting close, but let's say that we were both 62, right? Yeah. So we bought a home in the blank area. Anybody have a guess where?
Right. We haven't said it yet. So, folks, while Tom is saying that, where is Tom from? So you got four choices. Chicago is one. We'll say Pittsburgh is two. We'll say Boston is three. Then we'll say Las Vegas is four. Can you all tell from where Tom is from based on his accent? Now, I won't say any more. But anyway, keep going, Tom. We'll see what the peanut gallery say.
All right. So let's assume we bought a house worth, use real numbers so I can remember them, $430,000. And again, we're 62. So based on our age, based on whatever their interest rate happens to be, we could finance a certain percentage of that purchase price. Let's say it's 40%. It's usually a little less in the purchase example. So if I take 40%, so let me think, that's 172,000 that we could finance towards that purchase price of 430,000. So subtract 172,000 from 430. That's how much we would need to bring to the closing, right? To buy that next home. So $158,000 we'd need to bring in cash. Gotcha. Now, with the purchase option, just like the other uses where you're in an existing home, you don't have to make a payment. I could buy that next home, never, in that example, never have to make a payment for the rest of my life. And by the way, Josh, let's say I say, well, you know what, I'm going to bring $200,000 in cash. I'm only going to finance 130. I could have a bit of a credit line available in that scenario.
Can you do a subordinate home equity line if you have a reverse mortgage?
No, the reverse mortgage has to be the only mortgage in place on your home.
Okay, so there can't be a second at all. It's got to be the reverse mortgage. Okay, right. Gotcha. All right, gotcha. Well, that answered my question there. My man David says, if your home is under a trust, I presume it's a living trust, and the recipient goes to a nursing home, what protections are in place?
You read my mind. I'll sort of break that into two parts. Depending on how the trust document is written, if it's basically in a living trust, then it's likely possible. I'll qualify that possible. You could use a reverse mortgage. Again, what you'd have to do is have the lender take a look at your documents. I'd be happy to facilitate that. And then the protections in place if. In any example where let's say, my wife and I use a reverse mortgage and we live here for, 30 years. Let me give you two what ifs around that. One of the first uses I saw was an 82-year-old couple. So forget us for a minute, from Buffalo, New York. The husband was sickly, needed to go into a facility. The wife was healthy, wanted to stay in a home. They look to use a reverse mortgage credit line option to pay the entry fee for the husband, and the wife, as long as she stays in the home, the mortgage or the loan doesn't become due and payable. Now let's take an iteration off that. Let's say 6 months later, unfortunately, Mrs. requires care and she has to leave the home. Essentially, when you're out of the home, if both are out of the home for 12 consecutive in all capital letters, months, then the note or the loan is due and payable. But if during that time, let's say Mrs. 5 months and 10 days into it, came back into the home for one night, it actually resets the clock to zero.
Really?
Right. Yeah,
Wow.
absolutely. So again, your risk is if both are out of the home for 12 consecutive months, that's when, and you have time. I mean, you have time to put it on the market and try to sell it. Yeah, absolutely.
Yeah, I mean, and your lender, look, I'm not here to defend the banks, but I mean, lenders aren't in the business to be real estate agents, if that makes sense. I've never understood, like, the bank wants to take over my home and, put it in there. Look, I was in banking for many years myself, a long time ago, Tom, but the bank has no desire to be in the market of listing your home and showing it. I tell you that right now.
Absolutely.
My man Sergio, who's actually pretty smart on this regard, he says a higher rate. No, go ahead.
I'm sorry. I know Sergio. Just chatted with Sergio. Yep.
Hey, all right. Well, I feel bad for you, Tom. We will. A higher rate is preferred for the higher growth on the line of credit. What do you say to that?
There again, it depends. There are trade-offs. We looked at that with Sergio. Again, we can model that versus a lower rate, so people understand the growth in that credit line. You'll have options. Generally today, in actuality, it'd be growing at about 2.25%, or let's say 3.5%. Literally, there's a range of options. Now, as rates rise, guess what? That 2.25, 3.5 is going to go up. So it floats with essentially the underlying constant maturity treasury, the CMT index, right? So again, if it's a rising rate environment, that's good. And if you choose a higher rate option, it accelerates the growth in the credit line. But if you have a loan balance, guess what? It's the same percentage, right? So you have to think about it.
I can agree more with this. Seeley, she says, doing the reverse mortgage, at least a line of credit at 62 makes sense. I'm amazed how many people and maybe it's my lack of explanation, but I'm like, yeah, go ahead.
Yeah, I share the view. Sorry, I don't mean to wave and whatever, but back in the day before there was a change in 2017, you could literally put a reverse mortgage credit line in place for $125, right? And it's like, why millions of people didn't do it, I have no idea. Probably because they all listen to Dave Ramsey and Susie Orman, by the way. But all right, I'm on record. But anyway, let me say this. I still think for many, because one of the things you can do if you have the initial cost, guess what? And again, I've modeled this 100 times. You can make small little payments for a few years, and you can knock that balance down to 1. And then you have this credit line that's going to grow in a pretty big way, and you have a safety net. So listen, if you're listening and you have millions of dollars and you have all the safety nets that you could ever think of, don't do it. I get it. But if you don't have millions of dollars and you don't have all the safety nets, take a look at this. That's all. I'm telling you,
it's just basic math too. If it's a 2%, front end, mortgage insurance, so a $200,000 house, it costs me $4,000. Let's just say my house grows at 7.2% a year for 10 years, just to double it. That means I'll now have a $400,000 house at 2%, which is $8,000 I have to pay for mortgage insurance. So the lowest, unless you're in a neighborhood that got gang infested, the lowest you'll ever have to pay for mortgage insurance is now, because assuming your house is going to continue to appreciate in value. Thus, take look at it, because you're sitting there thinking, I don't want to pay mortgage insurance. Well, the longer you wait, the more the mortgage insurance is going to be.
Right.
It frustrates me. And the reason it frustrates is because it makes sense. And yet people say, well, then why wouldn't Dave Ramsey or Susie Orman? And I'm sitting there, well, Larry Kolikoff. For heaven's sake, Larry Kotlikoff is a social. No one knows social. And I'm not yelling at you, Tom. I'm yelling just generally speaking, because it's just me. Larry Kotlikoff knows more about Social Security in his pinky than Tom, I, and all the people watching do combined. And he's not a fool. Now, he is a Boston University professor of economics, where the illustrious AOC got her degree from. So we will have to scratch that. But at the end of the day, there's not that many guys who are more financially astute than Larry Kotlikoff. And he, because Tom interviewed him, said, I want to talk about reverse mortgages as a benefit thereof. And if Kotlikoff can see it, and he's a very, let's just put it this way, or curmudgeon, if you know what I'm saying, for financial industry. He does not like the financial industry. And if he can come along and reverse mortgages, I think that can open the door for other people to say, there is a value here. Let me see if it works for me or not.
Yeah, Larry's a full disclosure, good friend of mine, and I've known him for 11, 12 years, and it took a lot of conversations just to get him focused. And once he really understood that credit line, it's interesting, Josh. I used to tease, I'm not trying to name drop, but Harold Ovensky, I showed him those bar charts, and he looked at me and was like, no, it can't work that way. And it's like, no. But anyway, Larry was the same way. He was like, no. And I'm like, yeah. And then finally the light bulbs went on, and like that purchase idea, like that just got him. He was like, oh man, this is like incredible. So
especially downsize. I mean, I got 4 kids, Tom, and the better half and I, we're not going to need this big fat house in 7-8 years. I won't quite be 62 then, but heaven forbid, the minute I turn 62, when we downsize, I'm using reverse mortgage.
Right.
Let's see here. So, Murphy, you're too young to do that. You got to wait till you're 62. So he wants to move to Florida and do the reverse mortgage purchase. Well, you better find a lady, or I guess we should say a spouse who's at least 62. So you got to find someone who's 62, my friend. Let's see here.
Or 60 with the jumbo proprietary product potentially as well. Yep. Could be 60. Yep.
So Patty asked a good question, and I think the answer is somewhat obvious, but she did come late, and we'll dock her a $50 late fee. What about those with more modest home values? This actually, real quick, Tom, and I'll let you take over the mic. I think the people with more modest home values are the most obvious opportunity here, indeed. And I'm not going to assume more modest home value means you have less in your 401k and all that. But I'm just saying, at the end of the day, the tax-free opportunity here is nuts. So, Tom, take it away if you would on that.
Yeah, absolutely. There's no minimum home value or minimum obstacle there. Absolutely. If you have your home's worth $70,000 or $700,000, if you're of the mind to take a look at it, absolutely.
It's all the same percentage based on your age and your equity.
It is, right. So the amount that you would be able to access for a $70,000 home obviously would be proportionate to that value of the home versus the $700,000 home. So there's going to be a difference there, right?
Good question. Some of this is subjective. Reverse mortgage with the step-up value. Any thoughts on that's actually? Any thoughts on that?
That's a beautiful question, man. I mean, this is like wow. This is a great audience. Very, very good. I mean, there must be some ringers in here. So I'll tell you, I have the benefit of not being the smartest bulb, but I've just seen a lot of cases, right? So I'll just share an example of a 92-year-old lady in San Jose, California, about 3 years ago when this jumbo product just came out. Had a home worth about $2.2 million, right? Wanted to stay in her home at 92. Who wants to move, right?
Right.
Kids didn't want her to move, whatever. But guess what? She had an existing mortgage for about $800,000 they couldn't make it work. Still had to make monthly payments, right? I share all this because guess what? If the thing about being able to stay in the home, she was able to use a jumbo reverse mortgage, get rid of that existing mortgage, access a credit line or additional cash, I think at that point of like $333,000. I did a whole case study on it. But here's the beautiful point is the step up value, because they were able to keep it in the family and ideally it'll end up in the estate. Guess what? The kids have the value, the benefit of the step-up basis, which means that when they inherit it, it's going to be at the then current market value, just so everybody understands, right? Yep. That's the benefit of the step-up basis versus if they had to sell it, which would have been
Yes.
horrible for that lady. They would have had capital gains because she was above the exclusion rates. And in California, on top of the federal rate, there's a penal state capital gains rate as well. So anyway, so yes, if you're looking to transfer it into the estate, that's one of the benefits if, again, the step-up basis stays around. So
I never
answer.
thought about that. So Harry from Oklahoma, when I know Harry pretty well, but
That's a great question.
And it's another feather in the cap for the reverse mortgages that I guarantee Dave Ramsey. And I'm not here to bash Dave Ramsey, but I'm just saying at the end of the day, it ticks me off when we paint with a broad brush financial products that can have a huge benefit to millions of Americans because the bulk of their financial assets are in their homes. And they're all worried crapless about they're going to run out of money. I'm saying, man, you got 300,000. And Tom, my mom, you know what I'm saying? I know my mom, she has a house in Shenandoah Valley worth $250,000, no debt on it. And they're like, that is an opportunity there at some point for her, should she need it. It's just that simple, not to at least, and she's all about it if she wants to, but not to consider it just doesn't make sense. But on top of the step up basis, Harry, that's a great question. That allows this lady to stay in her home and her kids to get that asset tax free as opposed to selling it. And like Tom was saying, paying that huge capital gain. Oh man, that's a huge. How much does the broker make off the loan? Any idea on that?
I would say for the brokers, I don't know that side. So you could think of it as two types of lenders. One is a broker, the other is a direct lender. So again, Joe Damo that I've mentioned a few times with SunWest Mortgage. SunWest is a big player on the regular mortgage side. They're a direct lender.
Okay.
Their fees, they may or may not charge, and Joe's very, very competitive with all this, an origination fee, fully disclosed, nothing hidden. Brokers, honestly, and again, I'm not trying to disparage them, but right. How they get paid, it's a little less obvious. It can be built into how much the client draws or uses. It can be built into the yield on the back end. I know, Josh, you're familiar with some of this. Yeah. So that's not as obvious to me. So I have to confess, I'm more of an advocate for the direct lender side.
And it's almost like the 65% of first year premium on a universal life policy. You know what I'm saying? So the broker has every incentive to get you to buy the biggest premium. My man Dougie B says, could this limit the value of equity left to the children? Absolutely. Because you're literally a debt on the house that's got to be paid at the death of the homeowner. However, freeing up the rest for parents to spend, such as on a second home, would equity still increase for the owner? There's a lot of what ifs in there, Doug. Tom, do you have any thoughts on that?
Again, there's been a lot of research done on this. To me, you take one situation at a time. There's been research that's been done that shows that really, depending on your circumstances, the use of reverse mortgage could actually create a larger legacy or pot of money to be left behind for your kids. Absolutely. Again, it's another asset. You're just making it fungible. That's what you're doing. But I would just say this: you just have to be smart about it. It's not like you've hit the lottery. Yeah, you're going to have access to more money, but I'm not here to preach that. But it's just like any asset in that regard.
Yeah, because in theory, Doug, you could literally say, I'm not going to. You could say I'm going to use the equity in my home, and instead that means I'm not touching my investments. And we'll just say your investments grow at 8% a year. Well, in that case, you're going to leave more to the kids. On the counter to that is, what if your investments grow Japan, 1990 to 2010, then you're going to be left to the kids less because your investments didn't do what you hoped, and yet now you have this debt. So it's at the end of the day, I would say if there are other ways, easy ways actually, to make sure you're leaving a legacy to your kids, just buying second to die life insurance and things of that nature, which Tom is here to talk about. But if leaving assets to children is a big desire, there are much more better ways that could be implemented. Not all the time, but that should be looked at for sure. All right, so going to the question of where you're from, we got Chicago. My man Daniel says Pittsburgh, Chicago, Las Vegas. A lot of people are saying Chicago on here. Brad says not Boston. Wow, everyone's saying Chicago and Vegas. Holy crapola. So
all right.
You want to break the news to these people, my friend Tom?
If I said black and gold, 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 or whatever it is, right? The song, black and gold, go Steelers, go Penguins, go Pirates. Anybody now? Pittsburgh. I'm a Yinzer from Pittsburgh, and that's a a term here of endearment, right?
Is that what they say? A yinzer? A yinzer?
Yinzer or yunzer. Yeah. Yeah. So hopefully yeah.
So did you say you're 58?
I am 60. I will be 61 in July.
So you remember when Franco Harris picked up the ball off the carpet for the immaculate reception, right? I mean, that was, that was the ref was we missed that call, right? And we admit that, right?
You know what, Josh? It's been a thrill. Thank you for having me. We only speak the truth here.
Right, exactly.
We will never tell. We will never tell.
Still such a great game, I mean, I used to love football, and I literally could care less now. As I get older, I just don't care. But man, just watching the highlights of the last play, and I think that's the AFC Championship, if memory serves. That was before my time, but I was a huge Raiders fan because my granddad had season tickets. Yeah, he had season tickets to Oakland Raiders, and seeing those highlights, it still pains me to this day. Almost as much as I'm from Maine, Tom, so I have to be touchdown Tommy, but almost as much as freaking David Tyree, the catch off his helmet.
Yeah. Oh boy, yeah.
So Kim says if the interest rate, I'm not sure what she's saying. If the interest rate increase over the life, I'm not sure what she's saying.
Well, so it's a great reminder. So depending on which use you have, right, you may have a variable interest rate or you may have a fixed interest rate. If you take a lump sum of money, you would have generally a fixed interest rate, or you pay off an existing mortgage, you could have a fixed interest rate. The credit line, that monthly payment option, those are variable interest rates. And guess what? Your rates can go up and down. We're sort of at the low point of it. Now, there are caps on how much that rate can go up over the life of the loan, whether it's 3 years, 300 years, whatever. It can't go up more than 5% or 10%. You have two flavors like that. And again, you want to make sure you look at multiple options and make sure you're looking at features like that. And I'll just volunteer one last time. I'm happy to look at anything that you look at along with you.
And just going back to Sealy, safety net for home health care, major repair expenses, fun stuff, no children to leave anything to. I was talking to a guy today, Tom, who's going to move from Connecticut down south, and single guy, no wife, no kids, no nothing. He just likes to play golf and hang out with some friends. It's like, dude, reverse mortgage is perfect for you because you have. I mean, there's no one to leave money to. Who cares? You're gonna be dead. And he's like, absolutely. So, my man Harry says he's the same age with you, Tom. So Harry worked in if memory serves, the oil fields for many moons, and then his better half wanted him to move closer to where she's from. And Harry says, he said, well, I'm in Texas. I want to stay in Texas. And the better half said, at least we can move halfway. So they moved to Oklahoma. That's where they are.
Okay.
Yeah, no way it was a catch. Yeah, right on. So we're killing you, Tom, on the immaculate reception. And then Dougie B says a steel curtain. Oh, man. All right. All right, that looks good. So we've had so first and foremost, the viewership that's on here. Thanks for y'all for being here. This is fantastic. Tom, you don't mind people reaching out to you? I mean, I don't want people to irritate you, but we got 140 people on here on a weekday night. That's pretty good, actually, and there will be a lot more that watches this afterwards. But I'll leave all the notes for Tom. Do you email that spreadsheet, or you kind of guard that?
I like to run the numbers in the spreadsheet myself because there are a few different moving parts. Again, I'll put up. There's my information. If folks wanted to email me, it's best tom@financialexpertsnetwork.com. And you can share that as you like, Josh, however you want to do that. But yeah, I'm happy to. And I may send you a link if you're looking for numbers that you can give a little bit of information, and then I would hand it off to Joe Damo, and I'll stay as involved or uninvolved as people want. Just want to make sure.
On the spreadsheet stuff, I just want to say, guys, it's I get requests on my own spreadsheets a lot, and I don't share those because it is kind of my own running thing in my head, and I literally it's like your pet, you know what I'm saying? So anyway, so Tom's happy to crunch numbers with you, chat with you via email, imagine by phone, but I would request that you don't say, hey, send me the spreadsheet so that you can crunch your own numbers. I know what that feels like, actually. I get that a lot. Like, I just don't like sharing that stuff because it's my own personal thing.
Yeah, let me just say, it's not so much even that. It's just like you have to know the right assumptions to put in.
Oh,
And I think I flashed that up on the screen. It's more that I'm happy to give it
understood.
to any, if someone spends a little time with me, I'm happy to give it to them.
Okay.
It's not the proprietary part. It's just I want to make sure they get it right.
And Tom does webinars on Financial Experts Network all the. Again, Joe Hurley from Saving for College. Maybe that's before we got on this. Joe Hurley, who I interviewed a long time ago too. Literally the 529 expert. There's no other way around that. Just all kinds of people, like people you have read about and heard about. Tom is interviewing these guys. Nuts.
Well, yeah. So like next week, next Tuesday, for example, I have I have a phenomenal expert on Medicare. Medicare remains a popular topic, right? So whether it's Medicare Advantage versus Medicare Supplement, my whole goal is just to make sure you get all the facts, and I go find the expert on it. So that's, next Tuesday. I'm doing Thursday something on special needs planning with ABLE accounts. I have the head of the Virginia 529 plan, Mary Morris, and American Funds on. The following week, I have a lawyer who's awesome who does special needs trust, because I've always wanted to do this. I have a special needs nephew, right? So we're always, I generally do 2 live webinars a week on a wide range of topics. And, I've had Larry on Social Security. I've had a former director of Social Security on, who's a good friend of mine, many times. Health savings accounts, student loan repayment options.
Yeah, student loan. I remember that. Yep, exactly. I remember that one.
Yep.
Wow.
So anyway, people are more than welcome, Josh.
That's awesome, Tom. Appreciate you being here, man. And I'm going to get my dog outside to go poopy. I will follow you up with an email, and we'll get this out there with the various ways people can reach out to you as well.
Great. Thank you. Thanks, Josh. Thanks, everybody.
Appreciate it.
My
Thanks,
pleasure.
Tom.
Okay. Thank you. Take care.